Hi, this is John Holohan, and I'll be presenting the Proactive Investment Strategy Update for Friday, May 19th. Well, we continue to monitor market conditions and economic conditions. Since our global buy signal occurred last November, we've seen the market move up and now kind of in a mostly sideways pattern. So we'll take a look and see what that looks like on our charts. We feel that we are at key resistance levels that we're going to have to break through to see if this market trend can continue. But we're bumping up against a pretty strong resistance level that I'll show you shortly. And market breadth continues to struggle. We just don't see the number of stocks participating in the current trend that we would like to. We need to see that market breadth increase to give us greater confidence that the current trend could be, a decent wealth building opportunity for some period of time here. We remain concerned about economic conditions as well. Joe pointed out last week in some of the key economic indicators we track, weakness, indicating a good possibility of recession. We don't know when that might occur, can't predict that, but it does seem to us that a recession is potentially on the horizon. And then, of course, we could throw in some of the news items, and I guess in particular, the one that's on everybody's mind right now is the debt ceiling negotiations. Will things get resolved in a manner that will be acceptable to the marketplace? And if we can get that issue behind us, will the market be able to break through those resistance levels and resume a decent uptrend, or on the flip side, potentially fail and begin another leg down? So there's a lot to digest, and we continue to monitor things closely. And as always, let's start our review at the dashboard. So at our dashboard, you can see still green across the board. We are coming off of that global buy signal on November 30th of last year. So we're a few months into this, and we're still concerned about the overall viability of it and still approaching things from a cautious point of view. The core indicators, you see a little bit of a mixed bag here. The cash comparison indicator, even though it's negative, it's not overly concerning at this point. There's a bit of a sensitivity issue there in terms of this indicator potentially fluctuating between negative and neutral and positive. And so we'll call this kind of marginally negative right now, but certainly we want to see this indicator improve. That would give us a little bit more confidence in the current bullish cycle. Long-term momentum indicator, Joe covered that last week, so we'll move forward here. And as well as the universe trend indicator, Joe covered that in the last report, and we really haven't seen any change there of any significance. So continue to be a bit of a lethargic movement in market breadth. So this is our longer-term breadth indicator. And this is one we really want to see some positive movement on, and we really haven't seen that to the extent that we would like to so far in the current trend. The tactical indicators are the shorter term indicators in our model, and so let's review these. Let's start with the 10-week indicator. Here's our 10-week indicator. This is where we measure the percentage of stocks that are currently priced above their 10-week average price. And let's just retrace a little bit of the history here. As the market came off of the October low, that period right in there for many of the major indices, that was the low point of the market pullback in 2022. And you can see coming off of that low, after moving into low risk, a little bit of consolidation, but a strong move up, a little bit of hesitation there in November, but then continued real strong follow through into November, and then a reversal down in December. And then since then we've seen some choppiness, and in particular a big leg down in this indicator in February of this year, and a big decline here, a lot of market breadth getting sucked out to, again, low risk. Now since then this is a little encouraging, but we really do want to see some follow through. This indicator has risen, a little bit of fits and starts, a little bit of hesitation, and now we're back to just about little over half of the stocks in the global universe are currently priced above their 10-week average price. So this would kind of be an early sign that things were improving from a breadth perspective in the market if we get some really strong follow through here Obviously, first step would be a reversal back to a column of X's and then some strong follow through. Obviously, we can't predict that that's going to happen, but this is one of the early on places that building breadth would manifest itself. Next, let's move on to our overbought, oversold indicator. I've got it set to a 3-year time period right now, and just to level set, blue line is the bull trend average. It's our calculation of where we expect the All Country World Index, which is the black line, to be on average during a particular cycle, whether it's a bullish cycle such as this period here, or when we move to a global sell signal, as we did twice last year, we shift our calculation and we calculate what we call a bear trend average. So that's the blue line here in a descending fashion. And then we draw whether a bullish or a bearish trend. We identify high risk up here in red. You can think of a market getting overextended, and at some point you would expect the market to pull back into the channel. And conversely, the green areas on the chart represents low risk, at least from a short-term perspective, as determined by our indicators. So the two global sell signals here last year, one in April, and then followed by a very short-lived global buy signal in August, and then quickly returning to a global sell signal here in September. And that's the low in the market, this October time period here. And then after that, you see the market begin to move up, triggering our global buy signal here on November 30th. Can't quite get it right on the dot, but right there at that point. And you can see since then, been a little bit range bound, maybe a little upward bias here. It's encouraging to see maybe some, slightly higher lows. Don't know where this will end up yet, but a higher low here is encouraging. But what I want to draw your attention to is kind of this area of resistance. This indicator, pretty much when it hits this 655 or 660 area, seems to really struggle. And we can go back all the way to the middle of last year when that resistance was hit, and it hasn't been able to really make a new high since then. And if we go back even further, you could see where the market today trades at just about the same level as it did back here in very early 2021. So that's a little bit shy of 2.5 years of no progress in stocks globally. Again, this is the MSCI All Country World Index that we're showing here. So while there was a market rally in 2021, it was given back and then some with the pullback in 2022 to that October low. Now we'll see if the market can gain a head of steam, get some increased breadth, deal with some of the news that the market struggles with from both economic perspective, and not only that, but again, some of the news items out there, such as the debt ceiling negotiations and how that might end up. Those are all worries for the market at this point. So it would be encouraging for us to see a decent breakout from these levels, really piercing that level of resistance here. That would be some level of confirmation that the uptrend was gaining some renewed steam. Again, it came off nicely off the October low, but then just this mostly sideways consolidation, perhaps, that's been a bit of a struggle for the market since then. Here's another one of our proprietary charts, and this is again a breadth indicator. We call this the bullish percent chart, and here we measure the percentage of stocks in our global universe that are on buy signals on their individual logarithmic charts. So again, more stocks on buy signals would be viewed as increasing market breadth, increasing participation in a trend, and that would be a good sign. And if we kind of retrace some of the recent history, the market hit its peak in January of 2022, or some indices in late 2021. And so you can see at that time, there was already some weakness here, in terms of declining percentage of stocks on buy signals. And so early in the year, you see this reversal down and some back and forth, and then into the summer, a low didn't quite hit low risk, and then some back and forth, and then ultimately the market low was put in that October time frame, and that 10 there of course represents the month of October. And then you begin to see a pretty strong move up here into November, December, and even into very early February, and then you see a reversal down here. And so this period in here very constructive, where we saw the breadth increase. But now, more recently, this has been a pretty sharp pullback to where, right now at 55%, just over 1 out of every 2 stocks are on buy signals globally. So for there to truly be a healthy uptrend in the market, a really good wealth building opportunity, we really want to see this reverse and begin to move back up and have that breadth expand. And so this is another area we'll be looking to see, for clues of that market breadth beginning to behave the way we really would like to see it behave. So to put a visual on the discussion about the national debt and where we are, first of all, the limit is 31.4 trillion. And you can see by the data that that's already been exceeded by just a bit. Well, there are some accounting, if you will, tricks that can be used to buy a little bit of time, but the issue's got to be addressed, in the not too distant future here. But you can kind of see this chart. It's a 10-year chart back to 2013, and you just see a steady increase in public debt. And then right here, of course, this is the COVID period with the requisite shutdowns and the injection of liquidity that went into the system in the forms of stimulus payments, etc. Just really ramped up and has kind of stayed at a pretty steep trajectory. And now we find ourselves bumping virtually right at that limit, just a little bit over $31.4 trillion. So it'll be interesting to see some of the back and forth in negotiations, how that goes. There could be more volatility in the market as this process unfolds. It's hard to predict how tough of a stand each side will take, but at least the discussions are underway at this point. I would like to check in on a couple of different areas that I think might be relevant here to market action. We've covered this periodically in the past, but this current chart, we've got a 20-year chart of the U.S. M2 money supply. And here you can see just a very steady increase in money supply up until that same period here. All of the shutdowns and related stimulus money that went out, and money supply popped and continued at an accelerated slope here for a while. But now this is interesting. You see this beginning to roll over. You don't see this very often, like an actual decline in the M2 money supply. So that could at least partially explain some of the volatility here in markets as the money supply contracts, and so not as much money chasing equities as there had been prior. So we'll have to see where this goes from here. This could be a factor to keep an eye on, but where all of this had been tailwinds for stocks, this sharp increase in money supply, this decline now becomes headwinds. So we'll have to see where we go from here with M2 money supply. And now let's look at one more kind of macro indicator that we check in on periodically. And this is generically known as the Fed balance sheet. So it's U.S. total assets held by all Federal Reserve banks. And here I've got a 10-year view of this chart, and you see kind of a steady increase. This is coming off of the real estate bubble bursting, and then a flattening out, and then actually a little bit of a decline in the Fed balance sheet. In other words, assets being sold off or assets maturing and rolling off and not being replaced. Then you begin to see a little bit of a creep up in late 2019, and then this sharp increase. And this increase, of course, is very much federal government action in response to the economic difficulties associated with the shutdowns and the lockdowns. A little bit of a pause here, and then a resumption, And now, more recently here, the Fed talked about reducing its balance sheet, and finally it began to do that in early 2022. More recently, you see a little bit of back and forth, and this is some of the action that the Fed took to inject liquidity associated with some of the bank scares that we've had recently. But now it appears that reduction or so-called tapering of the Fed balance sheet continues. This type of decline in the balance sheet could be headwinds for financial markets. So we continue to see some conflicting signals here. Our market model is clearly on a buy signal. You see all the green in the dashboard. But our economic model is negative, and that tells us there is reasonable probability of a recession hitting in the coming months, but we won't predict what that timing might be. With the market bumping up against some key resistance levels, it'll be interesting to see if it can push through, gather a little bit more breath, and resume an uptrend, or if that resistance level is enough to stop the current trend and possibly even reverse it. And those breath indicators are very important. We want to really keep a close eye on them. We really want to see improvement there. The moves in the major indices have been fairly concentrated in some of the mega cap companies, and in our opinion, it's less likely a sustainable rally until market breadth expands. We'll see if we can get through the debt ceiling negotiations here and at least put that behind us. It's a big unknown for the market and somewhat unpredictable response depending on what might happen there. Generally, the government finds a way to get through the negotiations and then we move on to other business. But you never know for sure. Well, that will do it for today's update. We'll see you back here in 2 weeks. Have a great weekend.